A lot of times I'll speak with individuals who feel that they are too old to get a life insurance policy. And this is because someone told them that they were too old, they did some research online, or maybe they even looked at a quote years ago and they felt they were too old then because it was expensive. However, if you're getting a whole life insurance policy and cash value is your goal, you can start a policy in your 70s and still see very attractive results. So today, we're going to look at life insurance policies for a couple who are currently in their 70s, and we'll also look at what is called a survivorship life insurance policy, which can be a very attractive option for older individuals. So let's begin with this couple's goals, specifically with life insurance policies. So the couple is interested in whole life insurance, firstly, to grow the cash value. Secondly, to be able to use the cash value, specifically for real estate deals. And then number three, they want to be able to leave a tax-free death benefit to the next generation. Those are their primary objectives. So when we look at the couple, the husband is 73 years old. The wife is 78 years old. However, they're both very healthy as they've taken very good care of themselves over the years. Now, what they're considering in terms of life insurance policies is funding of $50,000 per year for 6 consecutive years. And this is what they're looking at for each of them. So that's a total, 50,000 times 6, of $300,000 over that 6-year period for the husband and then also the wife. So a grand total of $600,000 is going into their overall plan. So when it comes to a whole life insurance policy where cash value is the goal, what company do I pick? Because there are a lot of life insurance companies out there. Well, firstly, I always recommend considering one of the 4 major mutual companies. Those companies are MassMutual, Guardian, New York Life, and Northwestern Mutual. The simple reason why is proof of performance. In their particular case, we've been focusing on Guardian. They are a major mutual company. The main reason why, though, is because Guardian still allows us to design a policy with a very low minimum premium for individuals who are in their 60s and 70s. So let's start by taking a look at the illustrations, and what we'll look at are the single life illustrations first. We've got the husband, 73, $50K per year for 6 years, and then we've got the same thing for the wife, who's 78, $50K per year for 6 years. So all of the numbers you see will be based on these illustrations. Let's take a look. Starting with the husband, here is our single life policy with Guardian. He's looking to fund $50,000 per year for 6 years. The worst year is the first year. He funds 50, he has 42.5. No matter how we spin that, that's a loss of about 15%. When people ask, what are the drawbacks to high cash value life insurance? My immediate response is the number one drawback is always the first year. Even when we set a policy up with minimum expenses and maximum cash value, I still take that first year hit, and it takes several years to recover as well. For example, in his case, he recovers in almost 5 years. He's paid in $250, he's at $248 and change, but then he's actually cash positive by year 6, meaning at that point in time, he's funded a total of $300,000 into his policy, and he's got 305, almost 306. The annual yield, when we look at that, that represents his bottom line, the true growth rate year over year. Not the dividend, because the dividend rate with Guardian in this illustration is 6.25%. Whatever your dividend rate is in a whole life insurance policy, your money will never grow by that because you also have the insurance expenses with the policy. The annual yield, also known as the annual rate of return, gives you your net growth rate on a year-to-year basis. Here's the same product for his wife. Very similar results, cash positive by year 6. So what we did here is put together a personal balance sheet for them, as if we're going to run their personal finances as a corporate balance sheet, which I have a lot of fun doing. So, husband and wife, combined policy values. They're each funding $50,000 per year, which gives you a total of $100,000 per year. 50 plus 50 is 100. There's the combined cash value, and the combined break-even point is between 5 and 6 years. Combined death benefit that will be passed to the next generation starts out at about 830, takes a slight dip after policy year 7, and then we see it recover over time. So, those are the single life policies. Let's look at this alternate option that we're talking about today, a survivorship policy. So, what is a survivorship policy? Because a lot of people have never even heard of this. A survivorship policy is one policy on 2 individuals, most common, a husband and wife. Here's the big drawback to a survivorship policy. The life insurance benefit, also known as the death benefit, is not paid out until both individuals pass. What this means is if the husband dies and the wife lives for another 5 years, she does not get a life insurance benefit. The life insurance benefit would not be paid out until she passes. Or if she passed first, the benefit would not then be paid out until the husband dies. Both people have to pass, and then the insurance company writes a check for the life insurance claim. So that's the drawback to many individuals, and often the reason why people elect against it. However, here's some advantages. Because the insurance company knows that there is a very good chance that they're going to hold on to that life insurance benefit for a longer period of time, the expenses of the product are much lower. So what this does for you is for the same dollar amount, you get a higher life insurance benefit. You get more bang for your buck. And then if you're interested in the cash value, well, lower cost equates to greater cash value growth, a higher return when we look at the annual yield on the cash value. Let's take a look. So what we'll start with is this guy, the combined values of the 2 single life policies. Here we go. So there's your 2 single life policies to the left. We'll call this option 1. Now let's look at option 2. How does it look? Break-even point's better between years 4 and 5. How about the growth rate? When we look at the annual yield, a little bit weaker up front in the first and second year, but you're not in the red in the 3rd year, and as time passes, it picks up the pace. And keep in mind, this is for a couple who are in their 70s, 73 and 78. With that said, if this were me, and I am comparing the 2 side by side, first, I would have a conversation with my spouse, or I would want my agent to have a conversation with me and my spouse, specifically about the life insurance benefit. And I would want someone to ask, hey, if something happens to one of you and the death benefit isn't paid out, is that a concern? Are you guys okay with that? If the answer is, yeah, we have separate life insurance policies, we're self-insured, or this is just purely a cash value play or estate planning play, that's where this product can work very, very well. So if I got an answer like that, I would check the box with confidence that a survivorship policy could be a good option in this case. Then the second thing that I would do is ask these 2 questions. what's the difference in cash? Like, how much more do I actually have? And that's an easy question to answer when we just compare them side by side. So here we go. Up front, we've got a little bit less. That's mainly because the PUA fee is a little bit higher on this option. If you don't know what that means, PUA stands for paid up additions. That's a rider we attach to the policy that accelerates the cash value growth. But up front, I have a little bit less. However, as time passes, I've got more than a little bit, a lot more. So that's the first question I would ask, and I would want a visual. And the second question I would ask is, well, how much more insurance do I get with this? Especially if my objective is to pass the insurance to the next generation. Here we go. Starts out at about $200,000 more. And as time passes, depending on when they pass, the death benefit is around 200, at its lowest right around 140 or 150. But you've got an additional $100,000 to $200,000 that is being passed to the next generation. And remember, that's also passed income tax free. So it's going to give the kids and grandkids a lot more buying power than money that might be passed to them in an IRA or 401k. The one last note that I'll mention here is when you look at the death benefit with a survivorship policy, you won't see a big drop off in the death benefit where you will see it with a single life policy. With a single life policy, it's optional to reduce the death benefit at policy year 8. It has to do with IRS rules. It's referred to as a modified endowment contract or MEC, where after the first 7 years, you can reduce the death benefit, cut the costs, and see a faster cash value growth. That's why you see that annual yield pick up the pace here. However, with a survivorship policy, the rules are a bit different, and we can't reduce that death benefit. But in a case like this, it doesn't negatively impact our growth, and we don't have to worry about the death benefit dropping, which from an estate planning perspective, a lot of people value that. So back to the original question, am I too old to get a life insurance policy? In most cases, no, you're not. And regarding a survivorship life insurance policy, this is a very, very attractive option, particularly for older couples who do not have a concern of the life insurance benefit being paid out when one of them die. It's most common to see people use this product for large estate planning cases. That means someone has a estate tax liability and a very, very high net worth. That's where you see them putting in high 6 figures or 7 figures per year into these products. Or a case like this one, where they're very, very interested in the cash value, where this is a fantastic option to reduce the overall expenses. If you have any questions, please leave them in the comments below. And as always, I hope this helps. Thanks for watching.